Welcome to a video that I like to call the deep dive video, and I always feel I need to explain why I call it this. Every week I do a number of videos. I do a video each day, I do a weekly video, I do an intermarket analysis video. After this, I'll be doing a what to watch video. And then I go back and I look through all of the different charts that I use, and I pick out those charts that I really didn't talk about all that much. That's where the deep dive comes in. We're looking at charts that aren't blatantly speaking to us, but sometimes we can still get some clues from looking at these charts. This is being prepared for Monday, March 4th. The first chart is a chart of the VIX, but you don't see the VIX on here. It's invisible. What you see is a blue line that's a 50-period exponential moving average of the VIX. When it was first developed, the idea was to stay within a static range, 12 to the downside, meaning that there's really no fear in the market, 20 to the upside, meaning that there's a lot of fear in the market. Well, as the markets have evolved over the decades, the VIX doesn't stay in that nice, neat little range. The moving average measures the longer-term value of that range. And when we had the great financial crisis, the VIX really went up into a higher range. Then as things settled down and we started to go back up, we went into a lower range. Then during the COVID plunge, we went back into a higher range. And now it looks like we're going back down into a lower range as we've been hitting all-time highs across many indexes. We don't use this to make decisions. We use this just to get an overall look at what is the fear gauge of the market telling us right now. And as the market has been going up, fear has been dropping off. We also want to know how fast is the VIX actually moving. And I do use this at times in the daily videos. When the VIX is really going up quickly, we'll get an extreme positive reading. And what I use is an RSI based on 9 periods. When the VIX is really going down quickly, we'll get an extreme negative reading. And quite often, that can mark some kind of an exhaustion, either to the upside or to the downside. Right now, we're just a little bit below the midpoint, so there's been no need to show this chart. Then we look at a correlation between the VIX and the S&P 500, and this has been floating in and out of the videos over the last couple of weeks. When we go above this dashed line, and I'm looking at the middle area, this suggests that the market's getting very nervous. And when we spike up and then start to come down, that typically is something negative for the market. Now, there are exceptions, and we did spike up here, and we're coming down now, but we're still going up as far as the market is concerned. We want to keep an eye on this chart in case we spike up again and then start to come down to see if we're going to get some kind of a pullback in the market or a shift in the overall environment. Right now, it looks like that this is just showing that the market was nervous and they were doing some extra hedging and the VIX was going up a little bit. And now that we're hitting all-time highs, they're starting to take off some of those hedges. Then we look at the VIX, and then there's another indicator called the VVIX, or the volatility of the VIX, and we do a ratio between the two. Down below, we have a blue line that shows the overall direction of this ratio. When it's going down, that's positive. When this is going up, that's negative. We are going up, and it's a little hard to see here, but we're just barely starting to roll over here. If the market can continue to go up, we would probably see this start to turn down, but this can take a while to develop. Then on top of this chart, we have the MOVE index, which measures the volatility of bonds. In the middle area is the VIX, which measures the volatility of stocks. And then I have a study down here with a green line that measures the difference between the two. What I follow is the correlation on the bottom. The higher this reading, the more the MOVE index and the VIX are going in the same direction at the same time. And they're having a fairly strong correlated relationship right now. Then we do a ratio between the VIX and the MOVE index, and I follow mainly the moving average. When this is going down, that tends to be positive for stocks. When this is going up, that's negative for stocks. Right at the beginning of 2024, we started to go back up with the moving average, but if the stock market keeps going up, you can see we're just starting to roll over with this ratio. If we see more positive price action, we would probably start to see this moving average keep going down. Then this is another fear gauge, but since the beginning of the year, it really hasn't been helping us all that much. It's been chopping more or less sideways. Typically, when we're going down, that means fear is going out of the market. When it's going up, there's more fear going into the market. This is another fear gauge that continues to fall. And since we're getting some pretty good readings with our other indicators, I haven't been including this chart. Then this has been kind of frustrating. This tries to measure risk on versus risk off. High beta stocks. These tend to outperform when the market's going up. Unfortunately, they underperform when the market's going down. When the market's more positive, folks want to get into those. These are the mega stocks, the stocks that really outperform the overall market. And this ratio really goes up. When we're in a more defensive type of a market, this ratio goes down. Well, since the beginning of 2024, we've been chopping around sideways and we're not seeing really any direction with this ratio. Then just to keep an eye on, where are we from the previous all-time high that was set in early January 2022? As of Friday's close, we're 6.61% above the previous all-time high. Stockcharts.com has this thing called technical alerts. This is for the whole week. I do go over the daily alerts in each daily video. This gives us more of a big picture look. We start at the bottom and finish all the way at the top. The bottom is Monday. The top is the last thing that happened on Friday. When you see a lot of blue, that's more positive. When you see red, that's more negative. And then we have 5 main indexes that we follow. Of course, the S&P 500, which is the backbone of everything that I do. Then we follow the Dow, we follow the NASDAQ 100, the mid caps and the small caps. And stockcharts.com has this ability to rank them on a technical score from 0 to 100. The higher the score, the better looking the technical chart. They're trying to remove as much emotion as possible. And then I rank these from the best looking chart down to the worst. Still, coming in first place, even though it fell back a little bit into the 80s, is the QQQ, which is the ETF for the NASDAQ 100. It's coming in with a score of 89.9. In second place is the S&P 500 at 82.7. Then we have the mid caps, which did show a little bit of strength this past week, coming in at 73. And believe it or not, we do have the Dow, which had been doing quite better than this. It's coming in at 70.3. And even though they're in last place, the small caps had a really good week. They were up 3%. You can see over here on the right, we're seeing a lot of improvement here. They're coming in at 68.8. We're just trying to watch the small caps to see, because we've been faked out before. It's like they were really running to the upside only to turn around and come down. Is that what's going to happen this time, or are we going to see more follow through action? Then a short-term chart. This is a rainbow going from 10 periods up to 50 periods. All of the lines in the rainbow are going up and prices above all of the lines. This suggests that the short-term trend is quite positive. Then we look at a double and triple exponential moving average study based on 20 periods. Price is above both of the lines right now, so this is also suggesting the short-term trend is positive. Then this is a regular 20-period moving average. We have a simple moving average, which treats all 20 periods the same, and then we have an exponential moving average, which weights it more towards current price, and price is above both of these lines. Now, if we start to pull back, this is going to be the first area, one of the first areas of support that we're going to follow. There's another trend line that we've been watching too, and that's above these current moving averages. If we start to come down, we'll be watching to see if this 20-period moving average area holds. Intermediate term, we have another rainbow going from 50 periods up to 100 periods. The lines are going up and prices above the lines. The intermediate term trend is positive. Then we have a 50-period double and triple exponential moving average study, and we're coming out of the upper side of this triple exponential moving average. The red line is above the blue line. The red line moves faster. So when the red line's above, that means that we're going up pretty quickly. And the fact that price is even above that also confirms that the intermediate term trend is positive. Then this is where I like to demonstrate an anchored moving average, where most moving averages, you start from the current price and then work backwards. An anchored moving average goes to a previous price, in this case, the all-time high that we set back in 2022, and then projects it forward. Now, we're far away from this moving average right now. We did come down and hit it last October. This level looked like it was going to break, but it ended up holding, and now we're far away from that, so I haven't been showing this chart. I have a couple of other anchored moving averages going back to COVID lows. Then we have another oscillator. This is a Connors RSI, which acts very similar to a regular RSI. We look for extreme positive or negative readings. We're not getting one right now, which is why I haven't been showing the chart, and we're above the midpoint, so we're positive with that. Then we look at a 50-period moving average study. The lines are going up and prices above both of the lines. If we fall below the 20-period moving average study, The next logical area is going to be the 50-period moving averages. So if we really start to see a decline, we'll be watching this. But right now, we're far away from these lines. Here's a little further out, looking at a 100-period moving average study. Both of the lines are going up and prices above both. So our intermediate term to long-term trend for the market right now is up. Then we want to know how far away are we from the 200-day simple moving average. We're well above this right now, up over almost 13.5% from the 200-day moving average. Then this is standard deviation. We look at this to see how fast something is moving, not direction, just speed. And we were going up pretty quickly here. And so we started to see the standard deviation come above the moving average. When we really pay attention to this is when it gives us very high readings. We don't know if it's going up or down at that point, but sometimes when it really spikes up, that can show us that maybe we're getting exhausted, especially when we're going down and we get a high reading, that may end up marking a bottom. The mass index is not generating a signal right now. We want to keep an eye on the S&P 100, which are the biggest stocks in the S&P 500. We're looking for divergences here, and right now they're pretty much going more or less in tandem with each other. And then this is some measurements that I did, measuring from the low that we set last October to the all-time high that was set on Friday, and we're up a little bit over 20% from that low. This is the CMB Composite Index. I also use this like an oscillator. When we get above this black line or below this lower black line, that's when I really start to notice this chart. Right now we're going up, but we're not getting an extreme reading. Then this is the Pring bottom fisher, which is trying to give us a buy signal, which I guess is pretty good since the market's been going up. But we typically use this when the market's really going down, down, down quickly. And then these lines cross, and sometimes that can be a very helpful buy signal. Point and figure chart didn't generate any new X's or O's, even though we're going up. And we're still working off of the pattern that was triggered last November of a double top breakout. And so far, this is still looking quite positive. A long-term chart shows another rainbow going from 50 periods to 250 periods. The lines are going up and prices above all of the lines. So the long-term trend is also positive. This is a daily special K chart. I mention this in every daily video, but I don't bring it up because we don't get very many signals here. We are above this red line, so we are positive. And then we look at a weekly chart of the S&P on top, a weekly chart of the German DAX in the middle area, and we can see that they're having a pretty strong correlated relationship right now. So if Germany's going up or down, the S&P is likely going up or down too on a weekly basis. Then we look at the 10-year yield in the US and we subtract the German 10-year yield. And because US rates are higher, that gives us a positive result. And sometimes we can plot the US dollar index here in the middle, and we can see a strong correlation between the two. We're not right now. If we get up into this blue area, that would mean that the top chart and the middle chart are heavily correlating with each other, but this isn't really helping us for the time being. Then there's a thing called the Hindenburg-Ullmann, and the perma bears just love this. We did have an initial Hindenburg-Ullmann signal that was triggered, I believe it was February 1st. We're coming into March now, and we're not seeing a confirmation. What you have to see are two spike signals, that's these upper signals here, within 20 trading days, or roughly a month from each other. And this is not confirmed for right now. So we still look at this, but it's not really telling us anything for the time being. Some support and resistance levels. This is a mini rainbow of the open, high, low, close, and then I take a 20-period simple moving average of that. Sometimes when we're going up and we pull back, one of these lines will act as support. When we're going down and we start to bounce, one of these lines may often act as resistance. We're far away from all of the lines right now, so I haven't been showing this. We are getting kind of close to a new 50-day cycle. I don't use this to make decisions. What I did when I first started this is I went to about the COVID low and then noticed, well, about 50 days later, there seemed to be some kind of a high here. Then the next one just showed, well, we stopped for a little while, then kept going. So sometimes these are helpful, sometimes they're not helpful. With the last cycle was triggered on January 2nd. We're going to have another cycle that will start on March 14th. We don't know if it's really going to mean anything or not. So we just use this for information. Ichimoku cloud. This is a series of moving averages that are shifted forward. Sometimes when we're going up and we pull back, that may act as support. We're far away from the cloud right now, so I haven't been showing this. Looking at the broad market, we have the Vixen. We have the VIX for the S&P 500. The Vixen, you got to love that name. That is the measure of volatility for the NASDAQ 100. I mainly look at the line chart down below, showing that fear has really been dropping off. Then we look at a ratio between the Qs, which is the NASDAQ 100, and the diamonds, which is the Dow, and they're having a pretty strong correlated relationship right now. They're both tending to go up and down together. This is the bank ETF. We are keeping an eye on that. We have New York Community Bank that came out a few weeks ago and said, we got some problems here. And they came out this past week saying, we got bigger problems here. We're watching this because we're wondering if that's going to bring any other banks into the news. Right now, the bank ETF, it is in an uptrend, but it's pretty much been chopping sideways since the earlier part of February. We're going to be keeping an eye on this to see if it's telling us anything. We're also watching the regional banking ETF. New York Community Bank is a regional bank. And this is really underperforming the financial sector. The financial sector is in an uptrend. We're keeping an eye on that too, and I pretty much go through that in every daily video. But when you look at the regional banking ETF and compare it with the financial sector, the regional banks are back to really underperforming. We're also getting a little nervous about the transports. They are really underperforming the Dow. In a solid environment, we want to see this red line actually outperforming the black line, which is the Dow, and it's not doing that. But this is more encouraging. Home construction, a very interest rate sensitive part of the market. With the ratio between home construction and bonds, home construction is just really outperforming and setting new highs now. So this suggests that things are looking pretty good economically. Some rate of change charts, these are just for information. We are continuing to go up with our 250 period, and then here's a little longer term. We're getting up to this blue line, which sometimes can mean we're getting into an extreme positive area, but we can go well above that at certain times. Keep an eye on bonds. These are 1 to 3 year bonds, shorter term, compared with 3 to 7 year bonds further out. And when this is coming down like it was when we hit the top in October, that means that folks are really thinking that interest rates are going to start coming down. Well, as we got into 2024, this ratio started to go back up, but now we can see that this is starting to come back down a little bit. So we're going to be watching this to see if it can continue to drop, if this is something that's not lasting very long, and then it's going to turn and go back up. So I look at this chart every day, and if some changes do happen, I'll bring that up in the daily videos. This is an inverse of that same chart where we were going up as folks were preferring further out bonds, thinking that interest rates had topped out. And so you would want to lock in higher rates for longer. Well, then that all came into doubt, and this ratio started to go back down. Now it's starting to go back up. So we'll be watching this. Then we look at the TLT, which is the 20 to 30 year bond ETF. That's the blue line. And then we look at the S&P 500. We see that their long-term relationship is not really all that strong. It had been there for quite a while, but they're really going in opposite directions. And for a while, you could see that where the red line is going up, the blue line was going down. Their shorter-term relationship is getting stronger, though. So maybe they had a legal separation here, but now they're becoming friends again. We'll see if this rise in the shorter term correlation can turn up this longer correlation. And we look at a correlation between the Qs and the long-term bond ETF. They're going pretty much in opposite directions right now. And then this is keeping an eye on the yield curves. We have the 10 to the 2 and the 10 to the 3 month. These still remain inverted. The other yield curves that I plot, they've gone back to being normal sometimes. The two important ones are the top two, the 10 to the 2 month and the 10 to the 2 year and the 10 to the 3 month. Then we look at TIPS, which are Treasury inflation protected securities. When interest rates are going up, that's what folks want to be in. When interest rates have topped out and starting to come down, folks want to be in longer term bonds. This is starting to go back up again a little bit, causing us a little bit of a concern here. But when we look further out, we saw a real decline when we're looking at TIPS to 7 to 10 year bonds, because folks thought, okay, maybe interest rates are done being raised. And so that's why we saw this ratio going down. The other chart that we're looking at is showing some improvement, but we're still having a tendency to go up with this ratio right here. So the market isn't absolutely convinced that the Fed is done with interest rates or that the bond market is going to have even higher interest rates than what we have now. Then we look at cash, which is represented by a 1 to 3 month T-bill, and we compare that with 3 to 7 year bonds. When this is going up, that means cash is outperforming, believe it or not. When this is going down, that means longer term bonds are outperforming. We were starting to go back up, but lately we've been seeing this drop off a little bit. We're kind of in transition right now. Then this is measuring stocks versus bonds. When the ratio is going up, that means the market is anticipating a soft landing, meaning that we won't go into a recession. And that's pretty much what's happening. Even after Friday's session, we're hitting all-time highs with this ratio. Then I have a number of things that I call the possible positive scenarios, which I developed and really unveiled in 2022 because we were going down a lot and it looked like we were going to hit a bottom and then bounce back up. Well, some of those charts are also helpful, and I show them in the daily video. The other charts that I'm not showing right now are what I have right here. The first one, and I have another study of stocks inside the S&P and their 200-day moving average. This is different. This treats it like an oscillator. We look for extreme positive or negative readings. And in a general sense, if we're above the midpoint, 50, that means we're more positive than negative. We are going up and we're not getting an extreme reading. So I haven't been showing this chart, but it is looking positive. Take that same basic concept, but do it based on a 50-period moving average. This is the S&P. We did get extreme positive, fell back, and we're showing some improvement now as stocks have been going up. To get more of a perspective, we look at the mid caps. They also hit an extreme reading right at the end of 2023, fell back, and they're showing some improvement. And then the small caps also fell back after being extreme and showing they're weaker, but they are also showing a bit of an improvement. Then we look at a 19-day exponential moving average of the advanced decline ratio, and we break it down based on price and volume. We use this like an oscillator. I'm not using it that way now because we're not getting an extreme positive or negative reading, but we're above zero and advancing on both, so that is positive. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you have a great weekend, and I will talk to you in the next video.